Gold just had one of its worst single-day crashes in over 4 decades. Silver collapsed by more than 30%. And Bitcoin dropped nearly 10% in just a matter of days, pulling the entire crypto market down with it. The charts looked brutal. But the trigger wasn't a recession. It wasn't a war. It was a single name. Kevin Warsh. The man President Trump has nominated to replace Jerome Powell as the next Federal Reserve Chairman. And markets are panicking because nobody can agree on which version of him is about to take the most powerful seat in global finance. Welcome to Web3 Verse. Let's break it down. So who exactly is Kevin Warsh? He is not your typical academic economist. He is a creature of the markets. He began his career in mergers and acquisitions at Morgan Stanley before moving to Washington as an economic advisor to President George W. Bush. Then in 2006, at just 35 years old, he became the youngest Federal Reserve governor in history. And he was thrown straight into the deep end. Warsh served on the Fed from 2006 to 2011, which means he was in the room during the 2008 global financial crisis. He was the Fed's primary liaison to Wall Street, the person Ben Bernanke sent to speak directly with the banks when the entire financial system was on the verge of collapse. Since leaving the Fed, he has been a fellow at the Hoover Institution, a lecturer at Stanford, and has worked closely with legendary billionaire investor Stanley Druckenmiller. That last connection matters enormously. Druckenmiller is one of the most respected macro investors alive, a fierce critic of easy monetary policy, and someone who has long argued that the Fed's money printing is storing up serious problems for the future. The fact that Warsh has operated in his orbit tells you a great deal about his economic worldview. Now here's the question crypto investors care most about. What does Kevin Warsh actually think about Bitcoin? The answer is genuinely complicated. On one hand, he has said things that sound remarkably positive. In a conversation with Druckenmiller years ago, he described Bitcoin as the newest and coolest software and suggested it could serve as a form of discipline for policymakers. He didn't dismiss it. He didn't call it a fraud. He engaged with it seriously. In a 2021 television interview, he said that for anyone under 40, Bitcoin is the new gold, acknowledging that younger generations have embraced digital assets as a store of value the same way older generations embraced precious metals. And as recently as last year, he stated plainly that Bitcoin does not make him nervous and that it could function as a sustainable store of value. But here's where it gets more complicated. Warsh also wrote that crypto is software, not money. He has dismissed many crypto projects as speculative and even fraudulent. His position is one of careful pragmatism rather than outright enthusiasm. He respects Bitcoin as an asset, but he also sees it as a symptom of the speculative excess that easy money creates. And that distinction matters enormously for what comes next, because Kevin Warsh has a track record. And that track record tells a very specific story. Go back to 2008. The housing market was collapsing. Lehman Brothers was failing. Unemployment was heading toward 10%. Most Fed officials were terrified of deflation and a depression-level collapse. Warsh was worried about something else entirely: inflation. While his colleagues were focused on preventing economic catastrophe, he was consistently the voice in the room warning that the Fed's emergency measures were storing up inflationary pressure for the future. He eventually resigned from the Fed in 2011 primarily because he disagreed with the second round of quantitative easing, the Fed's program of buying assets to inject money into the financial system. He thought it went too far. He has spent the years since consistently arguing that the Fed's balance sheet is dangerously bloated and needs to be reduced aggressively. Right now the Fed's balance sheet sits at around $6.6 trillion. It has come down from its peak of $9 trillion, but Warsh believes it is still far too large. He wants to shrink it further through a process called quantitative tightening, the deliberate withdrawal of liquidity from the financial system. And this is where crypto investors need to pay close attention. Because if there is one thing that drives crypto prices higher, it is liquidity. When the Fed expands its balance sheet and pumps money into the system, risk assets including Bitcoin tend to rise. When the Fed pulls that liquidity back out, risk assets tend to fall. It really is that direct. If Warsh follows through on his instincts and aggressively drains the balance sheet, he could damage crypto prices even if he personally respects the technology. But here is the massive contradiction sitting at the heart of this entire situation. President Trump did not nominate Warsh because he wants tighter monetary policy. Trump has been extremely vocal about wanting interest rates cut aggressively, by 2 or even 3 percentage points. He wants cheaper borrowing costs to stimulate growth and reduce the cost of servicing America's enormous national debt. So we have a president demanding easy money and a nominee who has spent his entire career warning against the dangers of easy money. Something has to give. Will Warsh bend to political pressure and deliver the rate cuts Trump wants? Or will he hold the line on his principles once he is actually in the chair? Analysts are genuinely divided on this. Some believe his recent comments sounding more open to rate cuts were simply what he needed to say to secure the nomination, and that the hawk will return once he is confirmed. Others worry about a repeat of the 1970s, when a Fed chairman caved to presidential pressure on rates and contributed to a decade of damaging inflation that only ended when his successor raised rates to extraordinary levels. Warsh knows that history. He has written about it. The question is whether knowing it is enough to resist the pressure. There is also a scenario that might be the most concerning of all for markets. What if Warsh tries to satisfy both sides, cutting rates to please Trump while simultaneously shrinking the balance sheet to satisfy his own hawkish instincts? That combination of low rates with scarce liquidity would be genuinely unusual and could create serious volatility. Markets are already pricing in that possibility. The market reaction when the nomination was announced tells you everything about how investors are reading this. Gold didn't just dip, it crashed from near record highs to significantly lower levels in a single session. One of the worst single-day drops for the metal in decades. Silver fell even harder. Bitcoin dropped from around $90,000 to the low 80,000s. The reason comes down to what Wall Street calls the debasement trade. For the past year, investors have been piling into gold, silver, and Bitcoin based on one core belief, that the US government has no realistic choice but to keep printing money to manage its debt load, and that holding hard assets is the best protection against that outcome. Warsh represents a direct challenge to that belief. He represents the possibility that the Fed might actually restore discipline to monetary policy. When his name was announced, the dollar rallied and Treasury yields rose. The market's way of saying that maybe the era of unlimited money printing is not as guaranteed as everyone assumed. If Warsh succeeds in restoring credibility to the dollar, the short-term case for holding Bitcoin and gold as inflation hedges becomes somewhat weaker. Most analysts don't believe he can actually stop the long-term debt dynamics that have been driving those trades. The numbers are simply too large. But in the near term, his nomination signals a potential shift in direction. So where does this leave crypto heading into the rest of 2026? The Fed currently projects only one rate cut this year and one more in 2027, nowhere near the aggressive easing Trump has been calling for. If Warsh takes the chair in May, we are likely heading into a period of genuine uncertainty. The longer-term picture for Bitcoin remains intact. Warsh is not going to try to ban crypto. He understands the technology and may even push for clearer regulations that benefit the industry. But he is not going to stimulate the parabolic liquidity-driven rallies that have defined previous Bitcoin bull markets. Under a Warsh Fed, crypto may increasingly trade on its actual fundamentals and utility rather than on the back of monetary expansion. There is also the question of whether he even gets confirmed. A Senate confirmation battle could drag on for months, and prolonged uncertainty is something markets consistently struggle with. The bottom line is this: the era of the Fed always stepping in to rescue markets may be coming to an end. Warsh brings genuine credibility and seriousness to the role, but also a hawkish philosophy that has never been tested against a debt load as large as the one the US carries today. Whether that makes him the person crypto needs in that seat, or the person it fears most, depends entirely on which version of him shows up when it actually matters. That is everything for today on Web3 Verse. Drop your thoughts in the comments and make sure you are subscribed, because this story is far from over.